Hello and welcome to another episode of Healthy Trading Habits. My name is Justin Paolini, Head of Trader Development here at FCI Markets, and today we're going to talk about managing drawdowns. Before we start, please take note of the risk warning. Our investment products and services are not suitable for everyone. It is possible to lose all or part of your investment. For leveraged products trading, it is possible to lose more than your initial deposit. Trading on margin carries a higher level of risk, and it is possible to be required to deposit additional funds. You should not invest money you cannot afford to lose. With that said and done, this is me. The key aspects of this are that I probably committed every mistake in the book twice, and so I'm probably in a better position than most to let you know what doesn't work and to guide you towards what does work. Let me remind you also why we are doing this. Why, as a broker, we are going out there and giving you pertinent, relevant, useful information to help you become consistent traders. The reason is that we have office space in our offices and we want to expand our trading desk at FCI Markets. So we want to train you and we want to give you the tools to become consistent traders, and that way you can graduate and also move on to becoming a professional trader. So with that said, today's lesson is on how to manage drawdowns. Drawdowns happen to the best of us, but most traders on the retail side don't want to acknowledge that fact. And this is the kind of equity curve that most retail traders want to see. And that's why this kind of system is also the most popular on the usual social trading platforms, because it has like a 90% win rate, if not more. And after each drawdown, the system martingales and attempts to make it all back very quickly. However, there are inherent risks in this kind of trading. And for example, we would not fund a trader that operates like this because it's the opposite of what good trading is all about. In systems like this, where the trader is usually scalping for a handful of pips, but is holding on to losses for even 100 pips, okay? So where losses are 50 to 60 times as big as the winners, the entire profitability of the system hinges on the win rate. And that is not a good place to be, because the losses really have no limit. You really don't know how far the market can go against you before the trader makes it back. And what if the first martingale doesn't work? So if you're trading, if you're trading larger size to try and make back this loss, what happens if you have another loss? Well, then you're much deeper into the hole. And what do you do then? Do you multiply your position size again to try and get out of it? And what if you get another loss? There are so many things that could go wrong with a system like this, and it is against all the good trading habits that professionals adopt. So the first thing is accept the fact that drawdowns happen. This is my own performance when I was trading up to April 2020. Actually, this is until January 2020. There's a bit more profit, made it back up to the recent highs in April 2020. But as you can see, I suffered a huge drawdown. And there were various factors that contributed to this drawdown, but as a trader, my job was to get out of it, because drawdowns happen to the best of us. They happen to everyone. And the only thing to do is to understand and realize that drawdowns always happen, and that all we have to do as traders is manage them properly and try to get out of them as quickly as possible. But there is no escape, because various things can happen when you're trading the markets, various things that we cannot foresee or predict. We're in an uncertain environment. So it's useless to try and obtain a 45-degree upward sloped equity curve with no drawdowns. Okay, it's just not realistic. Drawdowns happen, so let's see what we have to do. So here are the questions to ask yourself when you get into a drawdown. Okay, first one. have market conditions changed? Because, for example, when I hit my drawdown, market conditions had substantially changed and I wasn't quick enough to adapt. In particular, volatility conditions changed, but also trending conditions changed. And those are two key features that strongly affect my own performance. The second question is, have I been underperforming on a technical level? So have I been sticking to my guns, executing my trades the way I've always been doing, filtering my trades, selecting them in the same way? Have I been doing the good things that allowed me to have a positive, equity curve up until now? And third, have I been underperforming on a personal level? So, for example, in my own serious drawdown, I was fatigued and I was facing burnout. So I had a mixture of personal issues and changing market conditions. And so given the personal issues, I wasn't able to adapt to the changing market conditions as quickly as I normally would have. But we have to ask ourselves these questions and be very objective about them, because otherwise we don't really know where to attribute the responsibility. And as traders, we always have to take responsibility for our performance, but we have to analyze exactly where the issues are coming from. Now also remember something. The expectancy equation clearly states what has to happen in order to stay afloat and get out of your drawdown. Okay, the expectancy equation is essentially your average profit or loss. So the win percentage, okay, is what everybody focuses on, but in reality it is the thing we have the least amount of control over. The win percentage depends only on your patience and your experience, because if you are waiting for conditions to set up for you, if you're waiting for the market, for example, to be in an established trend, if you're a trend trader, or if you're waiting for volatility conditions to accelerate so that they give you more potential profit on a trade that goes your way, or for example, if you're a mean reversion trader, you might also want to wait for volatility conditions to accelerate for there to be high volatility, because that's usually when there is a bit more mean reversion in play. So, number one, are you filtering market conditions properly? Okay, and are you waiting? Are you being patient enough? Are you avoiding getting stuck into unfavorable situations? Okay, are you avoiding unforced errors? Because that is what will help you maintain a higher win rate. Then the average win to average loss ratio, okay, which is very important and which should be strongly positive. Okay, your average win should be 2 to 3 times your average loss, and that depends on your trade management and your position sizing model. Okay, so your trade management will probably, hopefully, allow you to run your profits and cut your losses. Now, in terms of trade management, volatility conditions can help you understand when it's better to go for intraday versus multi-day targets. And then third, the loss magnitude. So how big your losses are depends on your stop loss. Okay, tighter stop losses will ensure that your losses are smaller, but they will be more frequent. So it's a trade-off, like everything in trading. Okay, it's a trade-off. However, we need to maintain our stop losses, and we need to continue trading in the same way that got us the positive equity curve, because unless the system is broken, unless you really have some statistics that tell you the system no longer works, then it's just a matter of waiting until market conditions are more favorable and then working your way out of the drawdown. But let's see what usually happens and what most retail traders do. The first thing is, instead of trading less, instead of being more selective, they trade more. Okay, they have the need to get it back. They hate being in a drawdown. They take it personally. They start feeling insecure, and they start trading more. And that usually gets them into a deeper hole. Then they might average down on losing positions, okay, because they don't want to lose money. They don't want to lose anymore. So they average down, thinking that perhaps if the position turns around, they'll be able to scratch it at par. The other thing they might be thinking is, I'm already losing. Perhaps if I average down, I'll get lucky. The third thing is that martingale position sizing tends to appear. And the thought process is, I can't lose indefinitely. So, the more I lose, say I have 7, 8, 9 losses in a row, perhaps the next one's going to be a win. So maybe I'll size my position larger on this next trade. Because if I do hit a winner, then it'll make up for a lot of losses. And if I lose, well, I was losing anyway, so it's not that bad. Then what they also do is I've seen people deposit more money into their account to keep positions open, or even add more. And of course, that's similar to adding to a loser. You're throwing good money after bad. Then the other thing that happens is they overanalyze. So they get stuck in analyzing what exactly went wrong. And this only leads to, again, overcomplication, because there are so many things we have no control over. And overanalyzing the situation, trying to find a reason for why things went wrong, usually doesn't happen. Sometimes it's just better to accept the fact that the market is not responding, and that we have to wait until the situation is once again favorable. Connected to this is the fact that they also add indicators in search of confirmation. Okay, this is again going down a dead end, because there is no indicator that can offer certainty. Okay, if you're looking for certainty, don't come to the markets. The markets are full of uncertainty. Then I've also seen traders drop down to smaller time frames in order to trade more frequently and get out of the drawdown quicker. Okay, so once again, this is forcing things. They're trying to trade more, and instead of trading more with their usual model, they're actually changing things, and they're going down to smaller time frames, just trying to make stuff back. And once again, this usually gets them into a deeper hole. And finally, they try to bring another trading strategy into play in order to raise the trade frequency, or trade within the current market conditions. But the thing is, if you still don't know what got you into this mess, what makes you think you can actually create another system, bring it into play in order to get out of this mess? Okay, so it's, what we need to do may be counterintuitive, but we need to flip all this on its head. We need to trade less and be more selective, because we need to avoid digging a deeper hole at all costs. Okay, number 2, we need to ensure that our trade management remains the same, always trying to run winners and cut losses. Okay, do not add to losses, do not try to force winning trades. Okay, just be selective. Okay, try to be patient and wait for the best looking opportunities, and then deal your hand. And then third thing, your position sizing model should have some risk limits. For example, a monthly risk limit. That means that if you lose more than X amount during the month, you stop trading. Okay, it's a hard stop loss, basically, where you stop trading for the month. But before hitting that, you might also want to have a drawdown tolerance level beyond which you cut your position size. So that way you can continue trading, being selective, of course, but at a smaller position size. It allows you more flexibility. Okay, so the pressure is much, much less, and you have space before you hit your monthly risk limit. And also, ensure that you are performing well personally, and that you are also being flexible enough to accommodate the different market conditions. Okay, so whatever the situation, ensure that you are being objective, you are performing well, you are you're maintaining your best habits, the best things possible, in order to come to the market and be your best. But when you're in a drawdown, the first thing that you need to think about is risk control. So try not to dig yourself a deeper hole. Ensure that you're sticking to your guns. You're not forcing trades. You're not forcing trade management. You're not changing things. And stick to risk limits. And ensure that you're doing everything possible to perform at your best. But also know that drawdowns happen. And you need to accept that fact and simply realize that the makeup of a trader really is the resilience to dig out of these drawdowns, to climb back out of them and to continue on growing your equity curve. I hope this was helpful, but if you need further guidance, here are a few things you can do. Number one, subscribe to our thought leadership. Come onto our blog, go down to the little box and insert your details, and you will receive our thought leadership and our morning calls directly into your inbox. Follow our Twitter calls at FCI Ltd UK. We only post the most relevant market moving information. We try to keep the signal to noise ratio very high, and we have the occasional chart analysis alerting you to things that look particularly interesting to us. We also have a free course. If you are new to trading or you're still having issues achieving consistency, well, there are 15 years of trading experience condensed into these lessons. So just go to our site, fci-markets.co.uk/promotions/free course. Or finally, if you do want to become a professional trader and get funded, come over to our academy at fci-markets.co.uk/academy. It is a full immersion course with constant coaching support, video lessons, live webinars, simulations, and the benefit is that successful candidates that come out of this course will have access to funded accounts. So if you want to become a fully funded trader, this is the pathway for you. And if you have any questions about anything, just get in touch and write to us at client.support@fci-markets.co.uk or give us a call. We look forward to hearing from you.